All right. Hi, everyone. Michael Mnatsakanian here. I'm a real estate investor that was able to become financially free through real estate investing before 30 years old, which is pretty sick. It took in total less than 4 years. I purchased the majority of my properties leveraging creative financing, as well as house hacking small multifamily properties, which means my wife and I bought a multi-unit, lived in one unit, rented the other ones out. That's how I started, and then really dove headfirst into creative financing as well as capital raising. So we've built basically the entirety of our portfolio using none of our own money. If you want to stay along the journey, there's a few ways to stay connected. So obviously, if you're watching on YouTube, my YouTube handle is Super Investors REI. So that stands for real estate investing. So Super Investors REI. Instagram is Michael M as in Mike, N-A-T, Michael M Nat. So the first 4 letters of my last name. And then if you want to be part of the live audience or ask questions so that I can answer them for you, the best way to do that is to be part of the Wealth Through Real Estate community. I will drop that link right now. So I have a free community called Wealth Through Real Estate, where we talk about how you can become financially free through real estate investing. I train on deal analysis in there, a lot of deal analysis. I train on how you can actually become financially free through buying and holding real estate, but then what you can do in the meanwhile to help you along that journey. For example, we have if you're a lender, if you have capital and you really want to be passive, or you want to lend to learn how you can become a capital raiser and then buy deals using none of your own money, we're a whole training series is coming up for lending as a private money lender and a private money partner. If you don't have capital, but you do have the work ethic and you want to learn, there's 2 great options, which are bird dogging, finding deals for proven buyers, and then getting paid for those deals or even getting some ownership, or capital connecting, where there's a buyer who has a deal that they want to raise money for. So now you raise the capital for that deal. And then once again, you either get paid for that or you get some ownership of that investment. So those are 2 great strategies, and there'll be more and more training in the Wealth Through Real Estate community for that. Let me drop the link. I put it in the, let's drop it right now. There it is on YouTube. And then I can pin it for now. Perfect. And then, so we have 3 questions. Before we get started, I just want to show you the Wealth Through Real Estate community real quickly. So let me do so. Let me screen share real quickly. Window. Boom. So this is the Wealth Through Real Estate community. This is where I posted the live office hours today. These are the 3 questions that we're going to be answering, community questions. How long should it take to analyze properties? Maximizing cash on cash return with real estate investments. And then why does Michael prefer to buy wholesale deals instead of direct acquisitions? I also shared a training on capital raising and deal analysis in there. We have just around 800 members. Let's see if I can expand it a little bit. There we go. We have around 800 members. There's the whole community forum board, so you guys can ask questions. I'm happy to answer them, or the community is great at answering your questions as well. The classroom, where we talk about, there's some admin stuff. Super Investor, which is my paid community, which is really focused on finding deals, great deals to buy and hold, and then raising the money to buy those deals. This is more for those buyers who wants to focus on that route. Then we have the traditional real estate investing training series. So there's lots of deal analysis and how to analyze deals traditionally. Same goes for creative investing. If you want to, subject to deals, seller finance deals, and then the live office hours calls. So these are also posted on YouTube, so you can just watch them on YouTube, or they're organized there as well. There's going to be 3 new training series starting in the new year: lending, bird dogging, and capital connecting. So be on the lookout for those. And the calendar, here's where you'll find these live calls. So if you're one of the first 15, you'll be part of the live audience. If not, then you can watch us on YouTube anytime as a live member or as a live audience. And with that being said, I'm going to be doing a lot of analysis, maybe not on this training, but leveraging the super creative real estate investment calculator, which makes deal analysis and capital raising an absolute breeze. So this is primarily for creative finance deals. So you can do all the debt information here, your income, your expenses, if there's a balloon on the deal, if there's, if the sub 2 original loan terms. Basically, it'll automatically spit out based on your info and your entry costs. Is this the deal or not? And if it's not for a long-term rental, it will push out what numbers would you have to get to make that a deal, right? So if in this scenario, you have to reduce the price, lowering the down payment, or in this scenario, just reducing the interest rate, at what reduction would it make it a deal for you? Not only do we have long-term rental, we have pad split. So rent by the room, one of my favorite strategies, midterm rentals. So it's like average stays of 30 days, typically 30 days to 6 months, and then short-term rental where the average stays 7 days or less. My two favorite being pad split and then really nice short-term rentals. But obviously I love long-term rentals, and I have several midterm rentals as well. So I'm not overly picky. As long as it's a great deal and it makes sense for my buy box, then I will buy it. And then just to stay connected, right, the Super Investors channel, which is where you'll get these live calls as well in the future, if you want to be part of them in the future as well. So with that being said, let's answer some questions. So we're going to start with the very first one, which was, how long should it take to analyze properties? So you saw that crazy spreadsheet, right? Well, I break analysis into two parts when I'm buying and holding real estate. I think of deal analysis in two phases. One of them, because the majority of deals that I buy are from wholesalers, the majority of deals that are coming my way from wholesalers are not deals that I would want to buy right off the bat. Either they have an HOA, which is a no-go for me. Either they're in a market that doesn't make sense for me. It's not a state that I want to invest in, or it's not, the population isn't big enough, or they don't have enough industries. So there's a lot of things that I can automatically filter out before I even ever do a deep analysis. One of the other things that I do quickly to analyze if an investment makes sense or not is if it's a sub 2 deal, there's very little you can do to increase your cash flow. If it's like a low equity sub 2 deal, because you're taking over someone's existing debt. It's like if you take out a whole new loan on a property, if it doesn't get the returns that you want, there's really nothing you can do to change that loan. That's why I like seller finance, because you can renegotiate those terms and maybe adjust it to terms that make sense for you to buy, that generates you the cash flow that you want. So what you're doing is you're quickly determining, is this property cash flow positive? It's the very first thing I'm doing is this cash flow positive based on the management strategy that makes sense for this investment? And like based on the property size, based on location, all that good stuff. If it's not even cash flow positive, I can filter that out right away, right? If it's a long-term rental, that's my plan for it, and it's losing money every month based on just the mortgage payments alone, it doesn't generate enough long-term rental income, that's not viable for me. I don't need to do a deep analysis. I already know that deal doesn't make sense for me. It doesn't matter if I can raise capital on it, if I can lower the entry, like none of that stuff matters if I'm looking for cash flowing assets, because you will never become cash flow positive in that scenario unless your rent increases, but now you're talking about a different management strategy, probably entirely. So for a long-term rental, I'm looking quickly, does the long-term rental exceed the debt payments? If that's not the case, cool, I know I can move on. For a short-term rental, for me and my specific buy box, everyone's different, but for my specific buy box, I only want to buy either very phenomenal properties that have tons of amenities, that house is a massive attraction, or it's in a phenomenal location that people are constantly visiting, and it's like located in a good area of that market. So if that's not the case, then there's no point for me to further analyze that as a short-term rental. I don't even need to look at the numbers. If this property is not in a market that I want to invest in, like it's not the location that I would want a short-term rental in, or it's not the type of property that I would want to own in that market. So that's another easy filter. And then midterm, it's not a huge thing of mine. I incorporate midterm with short-term as well. So I offer both. Typically, I'm not really doing a lot of midterm like outright. That's my only exit strategy for a property. Some people are crushing it with just doing that. But in full transparency, that's not a major focus area of mine. And then for pad split, right, rent by the room, for the most part, if I cannot have 6 bedrooms or more, it's not really a rent by the room property that I want to own. And I also only own rent by the room properties in the pad split markets. If you're not familiar with pad split, let me drop my link for pad split so that you can connect with my rep, Blake Lewis, who is phenomenal. And she can help get you educated on what is pad split, how can rent by the room make sense for you. Maybe you have some other properties that make sense for it. So let me drop that and then dive further into that. So drop that link in here, dropped it in the comments. I'll also show it. That's how you can grab the link. The main reason for using that link is then you are connected with Blake, my rep, the person I've been working with for the last 2 years, who has not only helped me tremendously with analyzing deals and determining good markets, but she's also an investor herself. I tend to not take advice from people who are not already successful investors. It just doesn't make sense when I can take advice from an investor already. So if I've ever worked with an agent, they're an investor and a real estate agent. If I've worked with lenders, ideally they're investors that are also lenders because they understand things at a different level than someone who's just buying a property or just getting a loan out for a primary residence. So that's one of the best ways to filter people out. It's kind of a pro tip. Same with all these reps, ideally property management companies. I want to make sure you are an investor yourself so you understand what I care about from my perspective. Same with, people I work with at PadSplit, Airbnb, whatever. I want to make sure that we're on the same page, that we understand that we are both investors, and so that we're speaking the same language. Okay, so we talked about some of the quick initial filtration or filtering of deals. So for PadSplit, once again, if it's if I can't make 6 bedrooms, like kind of the easiest rule of thumb for me is it's in a market that I want to buy in, which is where PadSplit has properties, like where PadSplit operates in, right? Let me see if I can pull that up for you. Just to give you an idea. So if it's not one of these markets, I don't want to. So very easily with PadSplit, this is why it's so great to have a good rep, because they'll show you how to access these tools. I'm not doing anything that's like something that you couldn't do yourself. Let's do that. Boom. So PadSplit is showing you these markets. They're saying, hey, we operate in all of these markets. So if I'm looking for a rent by the room, I'm not going to go to this part of Illinois or this part of Iowa. This is a huge reason why I don't really invest in rent by the room. Actually, I don't really invest much in the Northeast in general. Looks like they've expanded much more towards like this Eastern coast. For me, this is my primary spot right here. Right here is where I'm primarily buying my properties in the Southeast. Although I do own in California, I do own in Washington, I do own in Montana, and I actually own a lot in Alaska because that's where I started investing when I was in the military. Hence the Alaska military thing award that I got for my soldiers. So you can see where are they operating in. If PadSplit, a platform that is dedicated to rent by the room, is operating in a market, I know they have put the time and money and energy to determine that is a good market to buy in. That's similar to, or that's a good market for their strategy. Similar to, you might have heard someone say like the Chick-fil-A or the Whole Foods or the Starbucks model, where they only buy properties within a mile or two of one of those buildings, like one of those businesses. And the reason for it is because they are leveraging their market research, right? They're leveraging the market research of a Starbucks, a Chick-fil-A, a Whole Foods, and they're saying, hey, they decide to invest and build a business in this location. That means it's probably a good location for growth over the long term. So that's kind of what I do similarly with PadSplit. But even then, I do not own and nor do I want to own in every single PadSplit market. For example, I don't really own in Texas, nor do I have a major desire to. Potentially in the future, I'll buy some in certain markets of Texas. Louisiana is one of those that I just don't own in and don't really desire to. Same with Alabama. For me, it's this East Coast or like this Southeast portion, because I care about cash flow, properties generating more money each month than the expenses. And then with that goes cash on cash return. Whatever I'm investing, whatever I invest to buy the deal is justified by the monthly cash flow that I'm generating, right? So it's a cash flow and cash on cash return. It makes sense in that capacity and it benefits me that way, which is how I became financially free, was through cash flow, right? Through the cash flow generated each month. That is what covers my entire lifestyle expenses. But I also care about appreciation. Are these good markets where properties are appreciating in value, increasing in value? So do they have a lot of like great economic indicators? Are they in markets that other people are moving into? Are like places that people want to live in? Are they places that are a little bit harder to build? So one of the issues with Texas is you can just kind of build anywhere and everywhere. There's no shortage of land. And there's certain markets like Louisiana and Alabama, which are, they're good from cash flow perspective, but they don't appreciate in the same sense. So for me, between Atlanta, various parts of Georgia, North Carolina, South Carolina, and Florida, those are really solid markets for me and my buy box and what I'm looking for. Other people that I know and even help and educate, they want to buy 100 in Ohio and 100 in Alabama and whatever. Everyone's got their own goals. I'm just sharing with you my buy box. And this is a big part of it, is leveraging the data from PadSplit. All right, so we've talked about it on a high level. So filtering based on location, and then properties need to make sense. So I don't like to buy a property that's less than 6 bedrooms. So it's the property itself is rarely you're going to find a property that has 6 bedrooms. But for me, a good rule of thumb is 3 bedrooms, 2 bath, and at least 1750 square foot, because then I know potentially there's an office, a dining room, a living room. There's at least 3 rooms I can replace and turn them into bedrooms. Or maybe we have one in Tennessee where we've taken the whole basement and converted that into 3 bedrooms and 1 bathroom. So like I'm looking for opportunities to make more rooms out of what is already there. And it's much less costly to convert an existing room, add a few non-load bearing walls, than it is to just build a room from the very beginning. And what I really don't want to do is build too many bathrooms. Bathrooms tend to cost a lot more because you got just a lot more work. They take longer and they cost more. So having that at least 2 bathrooms is great, because a good rule of thumb is you should never have more than 4 bedrooms sharing 1 bathroom. And that's already kind of on the excessive end. So if I can at least have 2 bedrooms or 2 bathrooms and they're all shareable, I know that I can at least have 6 to 8 bedrooms, right? I really like the 3-to-1 ratio than 4-to-1, but that's a big part of it. So once the 90% of deals that I see, that's how I'm filtering them. So when you ask me how long does it take to analyze properties, 90% of them take me less than 5 minutes to analyze them and quickly filter, not a deal for me, not a deal for me, not a deal for me. And then I determine, okay, this one is not a deal for me. There's like 3 options for every deal. Immediately, it's not a deal for me. That's the 90% of them. And then it's, okay, this is a deal that I want to buy. Then I'll analyze it. Or there's a potential for this deal to be one that I want to buy, right? So if it's not filtered immediately, either I'm deciding I want to buy it, or I might be able to renegotiate. Let me rephrase that. So if a deal is makes it past the initial filtering of deals, right? It's one of the 10% that I decide, hey, I want to look into this further. I will either buy it outright once I analyze it. I will determine, you know what, I like the deal, but I need to renegotiate some of the terms to buy it. Or then I confirm, no, this is not a deal for me to buy, right? So these two are kind of the same. I'm doing the detailed analysis, which is what I showed you on the spreadsheet. I'm looking at all the different strategies for the property. I'm calculating after repair values. What is this property worth? And then what would it cost me to buy? I'm calculating rental income for all the different strategies. If it's not viable for short-term rental or midterm rental or whatever, if it's a 3-bedroom, if it's like a 2-bedroom, 1 bath, and only works as a long-term rental, it doesn't make sense to look at it as a pad split, right? So that's one less thing to do. What I'm doing at that point is whatever strategies do make sense for it, then I'm analyzing it in full detail, getting all of my rental comps, which long-term rental between a few different tools, and I can drop links for them, the tools that I use, between those tools, or we can do a full training on that as well, outside of this Q&A, between getting all the rental income for long-term rental, it takes around 10 minutes, maybe another 10 minutes of pulling my own rental comps, right? So leveraging tools to give me a rough estimate for long-term rental income, and then 10 minutes to pull my own rental comps in that local market. So that's 20 minutes right there. Pulling up the pad split info, if it's a pad split market, it's super freaking easy because you just click on it. You see the number of bedrooms that are available, that are potential, right? If you get a layout for the property, you see the number of bedrooms. It tells you in this market, there are this many properties, this many units, and I can actually just show you that just to give you a rough idea of like how easy they make this. And I'll do one of my favorite markets, Atlanta, where we own plenty of properties. So if I zoomed in to Atlanta, right? Here's Atlanta. And then I can choose the zip code, the location that it's in. So let's choose right here, so whatever this one is. And it says, let's do one closer because I don't really buy too far out. I have plenty of mine like in near the downtown Atlanta. So let's just choose one with more properties. 281 active units, 21 upcoming units. So this is how many they currently have, how many are coming up. And then they tell me on average, each bedroom is $185 a week. If it's got a private bathroom, so I ignore this one, and I look at if it's got a private bathroom, this is how much it rents for. If it's got a Shared bathroom is how much it rents for. Average occupancy is 90%, and it takes only 2 days to get the first tenant in there. As soon as it's live, you get your first tenant within 2 days. Within the first 3 weeks, you get 80% of the property filled. This is phenomenal data. So I take these two numbers and I'll show you right here on the calculator. So it's a pad split. Let's say the house is originally a 3.2, 2180, right? We're going to just look at it from a pad split perspective. We're going to ignore all other debt info for now. So the pad split section here. So we're going to say we're going to add 4 more bedrooms. That's what's available here, right? We're going to convert 4 more bedrooms. This is a hypothetical property, right? The cost to build those additional 4, all you got to do, this is automatic. What I put on average is $6,500. It costs us honestly closer to $4,000 to $4,500, but it's always better, especially if you're raising money or even using your own money. It's better to overestimate slightly the rehab, because if you have extra funds, you put it in reserves for the property. So if and when something goes wrong or it takes longer to rent, you have reserves set aside. So I'd rather slightly overraise than underraise and then ask my partners or have to put in extra money that I was not anticipating when I was analyzing the deal. And the furnishing costs, so I do roughly $1,500 times the total number of bedrooms. So it's the 4 bedrooms here plus the existing 3. That's kind of how I estimate it. $1,500. The bedrooms themselves cost between $800 to $1,200, depending on what level you're furnishing it. There's going to be, but that also covers like living room costs, any common areas like the kitchen, the bathrooms, maybe the backyard. That's also funds used to furnish that property. These are just rules of thumb. Like, don't use this as your end all be all. Get a contractor to give you a real quote. But this is a fairly good conservative estimate for that. Same for I'm sorry. You're looking at the wrong screen. Let's reshare that. Can you see the calculator now? Okay. So all I said is a 3-bed, 2-bath, right, existing. And then we're going to add 4 bedrooms to it. We're going to convert the living room, the office, and then there's 2 more common areas or whatever. We're going to split it up at 2180 square feet. That's kind of what we're saying for this estimate. Or we can go, we'll add 3 more. All right. So $6,500 to furnish each bedroom, or to build the 3 additional bedrooms, $6,500 per bedroom, right? 6,500 times 3 is $1,950. And then to furnish the property, it's $1,500 times the 3 bedrooms here, and then the existing 3 bedrooms. So 6 bedrooms total times $1,500 is the $9,000 to furnish the bedrooms and the common areas, which for a pad split like this, I would say, yeah, that's pretty close. $10,000 to $12,000 is fairly accurate for a bedroom like this, but it depends on where is your property located. Are you setting it up yourself? Are you paying someone to set up the furnishings? All those are factors. This is just a quick rule of thumb to determine what is your total entry cost for the property, right? The cost to build it, the cost to furnish it, plus the original entry cost. This is just for a sample deal. So we can just ignore that for this instance. And then I'm going to take this data from pad split. Let's see if there we go. So 264 for a private bathroom. I'm going to say 2 of them are private. So it's 264. And then 172 for a shared bathroom. Go 172. This is designed for pad split in mind. That's why it's set up exactly this way. That's the tool that I utilize for managing my rent by the room properties and how I gather all my data. So the debt information is pulled from previous, like it's just made up numbers, right? This is just from whatever's on the calculator. Here's the monthly income. Here's the debt payments, the PITI, plus any HOA fees if there are any utilities or landscaping. So I estimate around $600 a month. That is so market dependent, but that's going to cover a few $100 for water, electric, gas, and trash, $100 for internet, and $100 for landscaping. Maybe you're going to add a few more things, other expenses, just add whatever that is there. Maybe we're going to say, I don't know, maybe there's a pool. Maybe there's, maybe the utilities are not enough and you change to 800. You have to figure out these numbers for your market by talking to other investors or using this as a rough estimate. That's kind of the best that you can do in that market. Just estimate. It's better to overestimate your utilities than underestimate. But you can look up quickly by just gathering some averages in a market by just searching online. Pad split property management charge. So pad split itself charges around 8 to 10%. I can't fully recall for managing for utilizing their platform to find tenants. And then you're going to still need someone to move your tenants. Like that platform is very similar to what Airbnb does. That's how tenants book your property. That's how they communicate with you. That's how payments are made. They can submit maintenance requests or messages, but you still have to manage the property. If there's a tenant that needs to move in or come in or get a property cleaned, or someone's moving out, or you have to schedule a contractor or a handyman, you still have to do that piece. So we add the extra 5% to pay for those services if and when they come up, right? Or you can self-manage it, but you want to account for your time a little bit in that scenario. Vacancy. So it said right here, vacancy, 90% average occupancy. So 100 minus 90, right? Or 10 is your vacancy. So here we change that to 10% for vacancy. And the maintenance and capital expenditures. This is money you're setting aside as reserves if and when something goes wrong on your property. So maintenance is like plumbing issues, like basic electrical stuff, whereas capital expenditures are like the bigger things and you get replaced over time. So your roof, your appliances, your flooring, right? Where your maintenance is what do you need to do to just get the property back operational? Where capital expenditures are, you're going to have to pay these costs over some point. You want to set aside the funds for that so you're not blindsided when that occurs. Depending on how new and nice your property is, this could be lower. And then, so here it'll then calculate based on your income and your expenses. Here's your cash flow, $1,449 a month. For me, I set a goal of $1,000 a month per property. And then a cash on cash return, which is this cash flow times 12, right? So it's your annual cash flow divided by how much it costs you to get into the deal, $81,827. That's 21.3% cash on cash return, right? So this is telling me based on my goal of $1,000 of cash flow and 15% cash on cash return, this is a deal based on those two. And if I said, okay, I'm going to move forward with this deal and I want to bring on a private money lender or a private money partner, well, this calculator makes it super easy. This tells you year one, if your partner is bringing we have to switch the management strategy to pad split. So you have to select that and I'll update here. If your partner is bringing the $81,000 and let's just say it's 50-50 and 0 preferred return. So this is, you guys own it, 50% your partner, 50% you, they get 50% cash flow, you get 50% cash flow. This tells you the total cash flow for the property is $17,394 for the year. Based on that, you get $8,697, and they get $8,697 for debt pay down. You guys are paying down $5,000 of debt every single month. You're paying down the mortgage. A portion goes towards principal, a portion goes towards interest. And so like that's also included, right? And the amortization schedule is telling you, here's your monthly payment, how much is going towards interest, how much is going towards principal. So it is telling you, and every single month you own a property, more and more goes towards principal. And that's what this is basically showing you. This is your monthly payment. The blue line is the principal portion of your loan, like how much of it is paying down the debt, how much of it is going towards interest. Paying down the principal is literally paying down your debt. Your tenant is paying down your debt. The interest is an interest payment, right? It's kind of wasted money, but it is also a tax benefit. So you can use that as a write-off, and your tenant's making those payments, add that write-off for you. And the longer you hold, the way amortization schedules work is the longer that you hold that debt, the more payments you're making over time, the more and more is going towards principal. And this is kind of the inversion point right here, where in this particular instance, February 1st, 2028, an equal amount is going towards principal and interest. And then after that point, more and more is going towards principal every single month. And that happens like the lower interest rate, the sooner this inversion point occurs. And so the lower the interest rate, the sooner it occurs. And the longer you hold that debt, the more that's going towards principal. So let's move on from all that and let's get back to this. So this will tell you, okay, if you do 50-50 split, you find the deal, you raise the money from a private money partner who's going to own the deal with you. Here's your guys' total returns. It's all 50-50. They get 50% of the cash flow, each 50% of the total returns of the property. So the cash flow, the debt pay down, property appreciates in value, and then the tax benefits, the 2286 of tax benefits. There's the interest payments, which are tax deductible, and then depreciation of the property, which is tax deductible. Depending on your tax bracket, this is how much tax savings you will get. And for them, if they partner with you, they get a 10.6% cash on cash return and almost a 21% return on investment for you because you found the deal and using none of your own money. Your returns are infinite, right? You put no money in the deal. So any positive that you get is infinite returns. Doesn't mean it's necessarily worthwhile because you can have $1 and that be infinite because you put no money in the deal. So you kind of have to balance that out. That's why I make sure to set a cash flow and cash on cash return goal. But because you want to make sure, even if you're getting $1, even if it's infinite returns, you want to make sure that you're getting solid, like it's worth your time and effort to do that. All right. So I went through it in pretty good detail in regards to how long it would take me for like a pad split. Very easy with pad split. Like it's as easy as it can get. The harder part is to get a little more clear on getting your quotes. So that's why you do a rough estimate, because more often than not, you're going to have to estimate what it's going to cost to renovate the property and to furnish the property. The more you do, especially in a market, the more knowledgeable you get. And for my super investors, one of the tools that they are going to get access to are like, here's what it costs me to furnish my properties. Here's exactly the products that I buy. So you can estimate that. We might share that out to more people. I'll ask the super investors if they're cool with that. Otherwise, those are tools I'm providing to make it easier for them to analyze these deals, as well as the super creative and finance real estate investment calculator. This is exclusive to the super investors community to get a calculator like this. I do have a free one as well. Check the link in my Instagram at Michael Mnat if you'd like a copy of that free calculator. So this is the part that gets a little tough, is estimating rehab and furnishing costs. You get a pretty good idea after you do a few, and you can you can put it under contract and then get a contractor to come in, or put it under contract, the deal from a wholesaler, or send someone out even before you put it under contract to get you the quotes to build out the property. Pad Split also has referrals. So they have referrals for contractors and markets that they're operating in. That's another reason why if I'm doing rent by the room, it's in a Pad Split market, because they have all the resources that I need, or I reach out to my network of other investors. And then furnishing, fairly straightforward. The only caveat is, are you furnishing yourself, or do you need to add a few grand to get someone else to furnish it, whether it's a staging company, you hire someone on Thumbtack or whatever in that market. All right. I'm not going to go into short-term rental. There's plenty of great short-term rental analyzers out there. You can find a lot of content. You're going to do something similar to what I did with Pad Split for on AirDNA is a tool that you can leverage. And then long-term rental, we can do a whole deep dive on analyzing every single deal. But that's also what I provide you guys in my super investors community, the paid community, or even the free Wealth of Real Estate community. We go over that kind of stuff for you. All right, let's move on to the next. Are there any questions about deal analysis? So the 90% of the deals that I'm looking at, I can filter out within minutes because they're outside of my buy box. Then I determine, is this a deal? If it's going to pass my filter, I'm going to analyze that out of the way. I'm just going to determine, is the deal that I want to buy outright? Is it a deal that I need to renegotiate? Or is it a deal that still doesn't make sense? There's no way to renegotiate to make it a good deal. And the way that ties into the next question, which is maximizing cash on cash return with real estate investments. So there's really only two ways that you can maximize cash on cash return. They are increasing, like cash on cash return. The equation is simply your annual cash flow divided by your entry costs, right? So how much profit you're making each month, right? Times 12 for the year, divided by your entry costs. So it's what it costs to get into the deal, to renovate it, to buy it, the closing costs, any agent commissions, whatever, all those costs. That is the cash on cash return equation. The only way to increase cash on cash return is to increase your cash flow or decrease your entry costs. From my experience, the best strategy to do is to try to increase your cash flow, but you're limited in what you can do depending on the way that you're acquiring the deal. If you're taking on a brand new loan, the only thing you can really do to reduce that debt payment is to pay points up front. You're paying money up front to then reduce your interest rate, which is going to reduce your monthly payments. Is that worth it or not? You have to analyze the deal to determine if paying up front makes it worthwhile to then buy that property at a lower interest rate. If you're doing a subject to transaction where you're taking over someone's existing debt, well, there's really nothing you can do to reduce that debt payment. You're taking over whatever that monthly debt payment is. So you really can't do anything about that. Either it is going to cash flow or it's not going to cash flow with that debt payment. And then for a seller finance or a hybrid where it's seller finance plus subject to, then you have the option to at least try to renegotiate the seller finance portion of it to then decrease one of your biggest expenses, the debt payment. Because like utilities and all that, you can't really reduce that. like you can say, oh yeah, I'm going from 400 to 200. But in reality, when you have to pay $400, you just screwed yourself and your partners by just faking the numbers. But the debt is one thing you can adjust depending on the way you're acquiring the deal. So to increase cash flow, you can either decrease your expenses, the main one being debt, the main one being seller finance portions of creative transactions, or increase your income, which is implementing a different management strategy. Maybe it doesn't work as a long-term rental, but it works great as a pad split rent by the room, or a mid-term rental, or a short-term rental. Understanding these three have a little bit more risk, right? Because the different management strategies, you're gonna have to put in more money to be able to rent it out, because you're gonna furnish it first and foremost, plus probably renovate it. So these are gonna cost you more money to get into than your long-term rental. So there's ways to increase your income or decrease your expenses to increase your cash flow. If your cash flow is negative, it doesn't matter how low your entry cost is, because your cash on cash return will always be negative. Some people who are just buying for tax benefits, or a property is negative cash flow, but generates them lots of appreciation or debt pay down, it might make sense for them. But if your goal is financial freedom, you need cash flowing assets almost exclusively. You need positive cash flow, because that monthly cash flow is what allows you to be financially free. That is that $20,000 a month coming from my cash flow to cover all of my expenses and leave me enough left over to be able to reinvest into other investments or to lend out to other investors. So to maximize your cash on cash return, maximize your cash flow by increasing your income or decreasing your expenses, or reduce your entry. But if your cash flow is negative, doesn't matter how much you reduce your entry, it's still going to be a negative cash on cash return. If it's positive, lowering the entry could then drive it up. So let me just show you actually what I'm talking about, just to get a rough idea. So let's share this one as well on the calculator. Well, this is a demo one that I just got for you guys. So let's see if this is a hybrid deal. I think it is. So this is a deal right here where it's saying $240,000 purchase price, 10% down payment. There's subject to loan, $185,581. And the monthly payments on that is $843, right? So that comes from the original sub 2 loan. This was their original loan at $200,000 at 3% interest, 30-year term. This is when it started. So the monthly payment for that loan is $843.21. That is what you are taking over here. You're taking over those payments and the remaining amount of debt there. So you're buying at $240, you're paying $24,000 minus the amount of debt you're taking over. This $30,419 can either be paid outright, right, as a down payment up front, or you can finance that from the seller and pay monthly on that. For the seller finance, they're allowing seller financing instead of requiring, this would be $54,419. Like if you had $54,000, there'd be no seller finance loan. Because they're allowing you to only put 10% down, they're going to finance the rest. They're financing it to you at 6% interest over a 30-year term. Okay. Your entry costs include the down payment to the seller, right? That 10% we saw. There's an agent involved. There's a minor rehab costs. There is, let me move this. There's minor rehab costs. There's closing costs. There's some admin costs, reimbursement costs that you paid for upfront. So you had to pay for a transaction coordinator. You formed your LLC. You did the inspection. So costs you want to account for and make sure that you can either lump them as part of your closing costs. I like to separate them because usually when I'm buying a deal and raising money from someone else, these are costs I pay up front and they need to get paid back at closing from my partner. So I separate that so they understand. And then we're buying it from a wholesaler for a $10,000 assignment fee. We're also raising 3 months of carrying costs or reserves for this property, right? So we have the debt information, we have the entry costs. So let's go back to that pad split model. So in this instance, let's say it's only 2 bedrooms. Let's change this to 1. Let's see if that's all right. So this is not a deal. Okay. So how could we potentially make this a deal? Well, we need to increase the cash flow or decrease the cash on cash return. This one's not a deal because it's making less than $1,000 for the cash flow. So how can we increase that? Well, there's very few ways we can increase that. We're not going to say that this $600 of expenses can be like that still needs to be covered for utilities. We're not going to say, oh, my management's going to cost less or my vacancy is going to be less or my maintenance is going to be less. What we're going to focus on is the debt. That's what we're going to try to negotiate. And because we're taking over this $843, you can't change the sub 2 loan. That loan is what it is. You can't tell the bank, I want to pay you less each month. It is what it is. You're kind of like, that's there. All you can do is adjust this 182 payment you're paying on the seller finance loan. But in this instance, even changing this payment to 0, right? Just assuming there's no payments on seller finance loan, I can already tell it's still not going to hit your cash flow goal. So that's a very good way to determine this will still not make sense, even if I paid $0 for cash flow. It's still not getting me the cash on cash or the cash flow I'm looking for. However, you can say, you know what? I'm cool with $888, but that means I need to tell the seller, I can only buy this deal, this $30,419. I can't pay you this. I can't pay you a single dollar to make this deal work. What I can do is still accumulate 6% interest and at this $30,000 loan, and I will pay you all of that in 5 years or 10 years. So in 10 years, this $30,419 over 10 years is going to be $55,621 that you're going to pay them in terms of, that's what you're going to pay them in 10 years from now, right? So that's a way to make it work in the short term, but understand in 10 years, you have to pay them that money plus the interest in 10 years. It still doesn't make sense for your cash flow goal in this scenario. So you might just say, you know what? It's not a deal for me. Or you say, hey, you know what? It's close enough. It's close enough. And I'm willing to buy it with this cash flow if I can get this cash on cash return over 15%, right? Because that's really important. If you're raising money, you want to get it at a high enough cash on cash return that when you split it with a partner in you, it still makes sense for both of you guys. So what can you do? Well, you can reduce your cost to build the property or the furnishing costs, but that's not likely. So what you can really do is go into the original entry cost. You can either pay the seller less down. You can negotiate the agent commission. Your rehab cost is your rehab cost. Your closing costs are your closing costs. Your admin costs are your admin costs. So you can either renegotiate the assignment fee, the down payment to the seller, or the agent commission. What I would do is I would look at these three, and collectively they are $40,000. You can go to the wholesaler, right? If you're going through a wholesaler and say, hey, wholesaler, at $40,000 entry, I can't make this deal work. It does not hit the returns that I'm looking for to make this deal work. And I also, actually, you're also asking them to renegotiate this. This doesn't work at 40,000. Between the 10,000 I'm paying you, the 6,000 for the agent, or the 24,000 for the seller, the only way I can make this work is if we remove this seller finance payment. I will pay them the interest, but in 10 years on a balloon. But I need to either lower their down payment or reduce the agent commissions, or if you're open to it, the assignment fee. But I rarely try to negotiate the assignment fee with the seller. With the wholesaler, I focus more on the agent or the down payment to the seller, because I'm going to probably work with this wholesaler more than once, and I'm asking them to go back and renegotiate these deal terms. The great part is this monthly payment on the seller finance was only $188. That's not really going to change people's lives necessarily. So they might be willing to forego that, especially if you do something like, hey, seller, I can't pay you $24,000 upfront to make this deal work. I can pay you $10,000. And hear me out, all right? So that we drop that $14,000. Now your cash on cash return is 18%. However, because I'm a reasonable buyer and I understand why would you do all these things just for me, you can present this and say, hey, let's go this route. So I'm actually going to replace it right here, this 10,000. So your seller finance is larger, right? You're going to pay them more over time. And you can say, you know what? I'll even add an extra $10,000 to the purchase price. So in 10 years, I'm not only going to give you this $54,000 which is increasing in value at 6%. So that $54,000, I'm going to give you almost $100,000 in 10 years because you worked with me to make this deal work for me as well. So you're making a win situation for you as the buyer and a win situation for the seller as well. You're deferring a lot of this debt payment to maximize your cash flow and your cash on cash return. So you have $888 now, close to your $1,000 goal, and you have a 17.8% cash on cash return, which is a phenomenal cash on cash return. Just understanding that in 10 years, you're either going to have to sell the property or refinance the property to replace all that debt and pay them back their $100,000, right? You're going to need to pay them back that $100,000 for the seller finance loan, or you replace the seller with another loan. Like you can do it. There's a variety of strategies we can get into, just not at this moment. But you're either going to sell it or refinance it or replace the seller some other way, whether it's through your income or whatever it is, or you take out a new loan in second. to replace the seller. So this is a great way of like what I do quite often. If it's sub 2 only, I can't change anything. And if it's hybrid or seller finance, those are the ways that I would renegotiate it to make it a good deal, understanding that my goal is to maximize cash flow first, and then I'm focused on the entry cost as much as possible. Reducing that then allows my cash on cash return to increase, right? And understanding that I'm talking to another human being, I'm talking to various human beings. The agent is probably not going to want to reduce $6,200 of agent commission because that's all they're going to get on this whole deal. The wholesaler is doing all this work for me. They're not going to want less than the $10,000, especially if I'm asking them to renegotiate. But the seller, if I can make it enticing enough, even though I'm paying no monthly payments and I'm paying less upfront, if they're open to that, I can make it worth their while by adding another $10,000 to the purchase price and giving them their interest still, but just all in one balloon. So in 10 years from now, they're going to have over $100,000 to this balloon that they get to. They're going to have $100,000 coming their way in addition to what we're able to solve their problem now if they're open and motivated enough to sell it creatively. Hopefully that makes sense. If anyone has questions, go for it. Otherwise, I will hop on to the last question. Okay. Can you explain how properly partner with PMPs and PMLs on creative rentals? I can't seem to get anything to pencil attractively. Okay, so we'll talk about that next time. But the idea is if you have a PML and your PML, you're paying your PML 12%, right? You're paying your PML 12% interest rate. That means your cash on cash return has to be in excess of 12%. So you can pay a PML of 12%. So for example, when you go on the calculator and you say, okay, here's the amount I need funding for at 12%, you need to make sure that your monthly cash flow is positive after you pay your PML, the $597 a month, right? So the easy rule of thumb is as long as your cash on cash return is over 12%, I'd like to see over 15% to pay a PML 12% so you have some spread if and when something goes wrong. Like you need to have a high cash on cash return. And if it's a prime money partner, well, I showed you how, right? In this instance, year one, you're splitting it 50-50 with them, 50% ownership and cash flow. You're splitting the two deals, right? And they're going to get almost a 9% cash on cash return and a 20.6% return on investment for just funding the deal. You're going to find the deal. You're going to do all this analysis and structure it. You're going to raise the capital for it from them. They fund it. And then you're going to handle all the operations after. And they're getting phenomenal returns, almost 9% cash on cash return. And that's year one. It only gets better with time. And you'll see here by the time 5 years is up, it's 50%. So the average out, that's around 10% a year, right? So it's a little bit better than this 8.9% was at the beginning because your rents go up while a lot of your debt and all that stays down. And then you're offering them almost 21% return on investment because they also get, as a primary partner, they also get the appreciation benefits, the debt pay down benefits, the tax benefits. So you need to have great deals first and foremost. And that's why I say your deals need to have solid enough cash on cash return. So when you split it or you pay a PML, right? If you pay a PML, it needs to exceed what their interest rate is. Or if you split it with a primary partner, it's still good enough for both of you guys for the returns that you're looking for. Understanding for you as the buyer, your returns are infinite if you can fund these deals using none of your own money. We'll leave it at that for that question. Let's see. Do you buy sub 2 property that cash flow co-living but not long-term? Yes, Cheryl. I will buy properties, and I do buy properties that sub 2 if they cash flow co-living but not long-term rentals, as long as they're in great markets and they're great properties that I know if I'm buying them at great terms, even if it doesn't make sense and I can no longer do pad split or whatever, and it doesn't work as a long-term rental, I know because I bought it at great terms. Let's a 3%, 3% interest rate at 10% down payment. I know that if I had to sell that to someone else creatively, I can sell it to them at the same terms and get out of that deal. Even if it's 10% down, they pay and 3% interest, they take that over. Great, I'm out of this deal. Or more often than not, what you'll do is you'll wrap that to someone else. You'll make them put 10% on a larger purchase price or 15% on the similar purchase price. And they're going to buy it from you at 4%, 5%, 6% interest rate. Those are very easy to sell. Where people go wrong trying to sell these wraps is they're buying deals that only make sense with like a 20% down payment at a much higher purchase price. And the interest rate only makes sense at 12%. Well, yeah, that's a stupid, like that you're putting yourself in such a box, which if you have to sell a property, you're really screwed. No one's going to want to buy that property from you. However, if you're doing it and you're buying great deals, even if it no longer works as a long-term rental or co-living or whatever, you can still sell it to someone who wants to live in it and offer them great terms that they're not going to be able to get from anyone else anyway, because the bank is charging them 7, 8% and 25% down, right? So that's why I'm open to it, and that's why I do it, because I know there's various ways to get out of it. Number one being providing this as a home for someone who wants to live in it at great terms. Are my PMLs and PMPs bringing 100% to these deals to make it a cash deal, or are you financing any of those? Are your PML bringing? No, so I've never funded 100% of a purchase outside of a renovation, like a flip or a BRRRR property where we're renovating it and then going to pull the cash out with a refinance. I've never asked the PML or PMP to fund 100% of the deal, because that's usually not the best way to do it, because then you're getting rid of one of the best benefits of real estate investing, which is leverage of that debt. And if you're using the PML or PMP as the leverage, well, you're paying them a ton of money. I'd rather pay the bank 7% or 8% than pay a PML 12%, right? So it just doesn't make sense, like mathematically, to bring them in to fund the whole deal, unless it's short term, you're adding value to the property and then you're refinancing them out. So that makes sense in that regards. All right, the last question. So maximizing, why does Michael prefer wholesale deals instead of direct acquisition? So why do I prefer wholesale deals over direct acquisition? It's very straightforward. It's a lot of time, money, and energy that goes into direct acquisitions. I have to pull a list of potentially motivated sellers. I have to skip trace them, which all that stuff costs me money. I have to put them into my CRM. I have to cold call them. I have to touch base with them like 10 different times before there's even some motivation. I have to extract the information. I have to, once they are motivated, I have to do due diligence on the property. I have to put it under contract. I have to do all of this work before it's under contract. And there's no guarantee that I spend all the time and money and energy on doing all of that it's even going to become a deal. So for me, it's much better to leverage something like, let me show you. This is super investors only, so I apologize. If you're not a super investor, there's other ways to find deals. Go on Facebook, go on, join Sub2, get on email lists and all that. But let me show you. Just need 1 second. I'm going to show you. This is way easier. This is why I exclusively buy deals this way. Okay. All right. So for me, it makes way more sense to collaborate and work with wholesalers and buy deals this way than doing all of that crap I just mentioned to you. That is so much work. If my end goal is to buy and hold real estate, I want to be as efficient as possible to buy and hold real estate, which means I need deals and I need money. It doesn't mean I need to do all the work to find the deals, or it doesn't mean I need to do all the work to find all the money, right? That's what I really focus on, is raising capital from partners who are a great fit for what we're trying to do long-term. But then I don't want to spend all that time, money, and energy finding deals from directly from agents and sellers, because that's not efficient. I don't like to work 20 plus hours a week. I'm not Hermosi. I'm not all these people who want to live in a basement and just work and work and work and grind and nonstop. All I care about is efficiency. I care about results. I care about buying great deals and using none of my own money to do so. So I'm building my cash flow and my wealth through other people's money on great investments, because I'm providing them an investment opportunity. I care about that. Doesn't mean I need to do every step of the process, which is exactly what I teach in the super investors community, which currently is closed off. If you're interested in something like that, DM me, reach out to me. I will be reopening it in the future, but that's not the priority right now. Priority right now is for my current 80-ish members who I'm helping on their path to financial freedom. So for me, instead of trying to do all that work that I mentioned, I'd rather leverage tools like this to find deals that are already locked up and under contract. Texas deal, cool. Let me see more information on this deal, right? This is way easier for me to sit there and analyze anytime from any place. All right, here's a 4-bed, 4-bath, 1,600 square foot property. It's not furnished. There's no HOA. It's a hybrid deal. Purchase price is $367,500. Entry is $20,000 plus there's closing costs and TC. Here's the monthly payment. Here's the information on the mortgage, the interest rate, the PITI. There's no balloon. I would rather have all of this information, someone do all of this work for me and pay them the $10,000 that they wholeheartedly deserve, or $10,000, $5,000, $20,000, whatever it is, as long as the deal makes sense. I would much rather do that and pay them the well-deserved money for these types of investments than sit there and do all of that work to wholesale. As someone who's wholesaled over 100 deals, trust me, if you're going to wholesale anything, cash wholesaling is kind of the best for assignment fees. Creative can be great because you can solve problems that cash can never solve. But for me as a buyer, buying creatively financed deals from wholesalers is bar none like the best way for me to efficiently buy great investments without paying any money. So all this marketing and all that, I pay nothing when I buy a deal like this until closing. The day that we close is when I pay. Otherwise, I mean, I'm paying an earnest money deposit to get into the deal or to put it under contract with the wholesaler, but I'm really not paying anything until we close on the deal, but I'm raising the money so my partner is paying the money on that deal. Where if I am doing the deals myself, if I'm finding all these acquisitions and all that, that is not very efficient and it's costly with no guarantee that I'll find a good deal. So just leveraging deals like this all day is what I'd rather do all day. Looking at, okay, I want to find interest rates 0 to, let's say, anything under 5%, right? And for me, let's say I'm cool with California. I'm cool with Florida, Georgia. Let's just stick with those, right? Cool. Here's opportunities of 5% or lower deals, 5% or lower interest rate deals in these markets. I would rather just sit there and do this. It's more efficient. I can do this from literally anywhere in the world. I'm not dependent on the seller or the agent getting back to me. Like yesterday, I called an agent as part of sub 2 and Pace Morby's No One Left Behind challenge. He didn't answer. He texted me today during an inconvenient time and I got to get back to him. And by the time I get back to him, someone else will, and they'll get the deal. Like, why would I do that when I already have a property under contract and I can make these decisions from anywhere in the world very easily by just analyzing these deals? So hopefully that answers your question. Number one is efficiency. I'm not a wholesaler. I'm a buy and hold real estate investor who became financially free buying and holding real estate, leveraging other people's money. So I use none of my own money. I'm not straying away from that. I'm not working harder than I need to for no reason. That's really what it is. I enjoy my time. I enjoy work-life balance. I love my family. I want to spend as much time with them. Right now, I'm going to go on a walk with them. I don't have to worry about a seller or an agent. I analyze deals when it makes sense for me. And then we buy those deals. If they're great investments, or if they're not, but there's potential, I will renegotiate those deals through the wholesaler. That's 100% the reason why. All right, y'all. Appreciate you. Thank you. See you next week. And for my super investors, I will see you tonight during our weekly mastermind. Later, y'all.